Hello, everyone, and welcome. My name is Adam Manson, and I am the Chief Data Officer here at BVR. Our webinar today is titled The Stout Restricted Stock Study, Overview, Application, and Key Considerations. Before we begin, I'd like to remind you that your attendance today is eligible for one CPE credit. To receive the credit, you must answer 3 poll questions that will appear during this webinar, and you must complete and submit a brief survey within 5 business days. A link to the survey is included with your login email and is also available on the event page for the program. At the conclusion of today's webinar, you will automatically be directed to that survey. If you are registered as an additional listener, you must be on your own device so that you can respond to the questions and qualify for CPE. If during the webinar you have any trouble with the audio streaming, please try refreshing your screen to fix the issue. We will take all questions for our presenter using the Q&A chat function on the side of your screen. Again, to receive your CE credit for today's webinar, you must answer 3 questions that will appear at random times during this presentation. Now, I would like to introduce today's speaker. Patrick M. Polomsky is a director in the Valuation Advisory Group at Stout. He has extensive experience providing a broad range of business valuation and financial advisory services for public and private enterprises, with a primary focus within the firm's trust and estate valuation practice. His experiences cover a broad range of industries for a variety of purposes, including estate and gift taxation, income tax requirements, shareholder and succession planning, buy-sell agreement consulting, shareholder disputes, and other tax, corporate, and litigation-related matters. Mr. Polomsky is also responsible for maintaining the Restricted Stock Study, which is the most comprehensive database of fully vetted and screened Rule 144 transactions used by valuation professionals to determine an appropriate discount for lack of marketability. Our speaker's full bio can be found on the webinar presentation page as well. And with that, I will turn this over to you, Patrick. Have a great presentation.
Yeah, perfect. Thanks, Adam. Appreciate the intro there. Admittedly, I had a couple things I was going to use to introduce myself. I think you covered everything I was going to say. So enough about me. Just wanted to say, obviously, appreciate everyone taking the time to listen in on our presentation today. And obviously, thank you for the opportunity to kind of walk through it too. So I know Adam mentioned a little bit about questions. So certainly, I'll try to monitor the Q&A chat if people have questions throughout the presentation. So please feel free to go through that. But admittedly, just being a solo presenter, right, I'm trying to focus on the slides and stuff too. So if I don't get to your question, it may potentially be that I'm trying to, or maybe I'll answer it later because I know the topic's coming up, or certainly I'll try my best to do it during the presentation if I see some come through, or hopefully we'll have time at the end as well. But certainly if we don't get to it, I've been reassured that we keep log of questions and we'll make sure we get everything answered in some course. So just want to emphasize that as well. So yeah, so getting into it, right? So today's topic, Stout Restricted Stock Study, Overview, Application, Keys and Considerations. What we're going to be going through today in terms of the agenda here, it's difficult, obviously, because there's a lot we can chat through, right, when it comes to the topic of, valuation discounts in general, right, in terms of, discussing the source data, the studies, strengths and weaknesses, tax court cases, IRS experience, right? There's a lot of different avenues that we can go down. So, in terms of putting the presentation together, it was a little strategic where, I thought it made the most sense to break it up into 3, I guess technically 4 items that are here, just to kind of walk through and give an introduction. I thought where was it appropriate. So covering the overview, application, and certainly considerations as well. So given that the study obviously is a database of, private placement transactions, unregistered shares, issued by public companies, it's obviously important to talk about, I think first, what is restricted stock? So it's a little bit of a history lesson that may be redundant for some people to know, but I do think it's still important just to cover certain concepts there. So we'll talk a little bit about that. Then obviously we'll walk through the study itself, analytically, what's in the database, what we learned from it, how we can use the data, et cetera. We'll walk through the DLOM calculator as well that utilizes the database, both in theory, but then also I'll pull up the platform, through BVR as well, and we'll go through just a real quick example just to kind of walk through that as well, and then just some other key considerations, which is really just a couple sort of FAQ, I guess, in terms of how we can leverage the database potentially for other purposes, and just again similar questions that we often receive from subscribers in terms of how to utilize the database. So that's really the agenda we have. So I know we got a lot to cover. So I want to try to go through everything that I can. So first, again, talking through just an overview, kind of a history of restricted stock transactions. It's not meant to be a history lesson here. Really, again, there's a lot we can talk about over the many years that this has been a common topic, I guess. But really, I just want to focus in on the things that are relevant for application in the study itself. So, what is restricted stock, right? So, essentially we view it as, it's stock that's identical to the freely tradable stock of a public company, except for sort of this inherent temporary restriction that precludes us from trading on the market, open market. So, it essentially represents two identical securities, right? One being liquid, one being there's a temporary restriction. So that's ultimately what we utilize the data for, is to kind of calculate or estimate what sort of that lack of marketability is inherent of it. And using restricted stock transactions is obviously a great source data for that. So, it's used synonymously with unregistered stock. Public companies issue unregistered stock and private placement transactions. Letter stocks, another common term, essentially refers to, again, shares that cannot be sold through public transactions due to, security laws and regulations, not necessarily due to other contractual obligations between an issuer and purchaser, things like that, but due to security laws. So going back many years, subsequent to the market crash of 1929, I know this is going way back. I'll try to keep it brief, obviously, but there was a Securities Act passage of 1933, which essentially required registration of nearly all securities prior to them hitting the open market. So this is important just because, again, subsequent to 1929, the federal government essentially tried to prevent stock market manipulation, right? Recognizing long-term investors may eventually need to sell securities, right? But really trying to limit the short-term manipulation that was going on in the market. So that's kind of where the story starts, I guess, in terms of the first introduction in terms of the term. Skipping ahead a little bit more towards the fourth bullet here, I think it was in the early 70s, if I'm not mistaken, but Rule 144 was adopted by the SEC as essentially an objective safe harbor for the resale of these restricted securities. It has, or it did essentially improve sort of the liquidity of these restricted stock transactions that were, they're being implemented. So in order to prevent the purchase of these unregistered securities with a view to kind of resell them in the public markets, Rule 144 essentially required an initially a holding period to holding those unregistered securities before being freely tradable. Initially, that was a 2-year term from when the transactions were first purchased from the issuer or an affiliate before being able to resell them in the public. After this initial holding period, unregistered securities could be further they could be sold in a public market, open market, but they do need to comply with certain dribble out or volume limit provisions. So specifically, that's what's in this kind of second to last bullet. But the sale of unregistered securities during any 3-month period is essentially limited to, for exchange listed securities, the greater of either 1% of the outstanding shares, or the average weekly reported trading volume as well during the last 4 weeks prior to the sale. Or for over-the-counter issuers, it's just the 1% of outstanding shares. So again, a certain dribble out volume limitation there as well. And then, Rule 144, I mean, again, we could talk a lot more about it, but it also provides some additional requirements just relating to the manner of the sale and the filing requirement. Like issuers need to be current on all their SEC filings and things like that. So there are some other considerations or requirements that are necessary. Focusing again on just Rule 144, it's important to note that there's been amendments made. So I know the table on this slide here is very busy. There's a lot going on. So I'll just try to focus on really what the key areas are. And you'll see reference to, affiliates and non-affiliates, right? And when we use the term affiliates, it's essentially referring to, or can be viewed similar to like insiders, having financial knowledge or about the company, or maybe owning a substantial block of shares, kind of being viewed as an insider, is kind of similar, used somewhat synonymously with the term affiliate. So that's, you'll see that kind of designation in a couple places. But Rule 4 and 44, as I mentioned, it's been amended over the years a couple times. The 4 times I'll talk most about that, again, impact the way that we utilize the study for applying a discount for lack of marketability, are those 4 years that are listed there. So 1983, what changed there is essentially non-affiliates could sell unregistered securities without any sort of volume limitations after a 3-year hold from the purchase. So that was in the early 80s. 1990 was sort of this tacking concept had been amended. So prior to 1990, any sale of restricted stock essentially required the holding period to restart back over at the 2-year holding period. Now, though, as a result of the amendment, non-affiliate purchasers can essentially tack on the holding period that the prior or the seller had incurred from that holding period. In 1997, it was further amended where instead of the initial hold being 2 years from purchase, it was reduced down to 1 year. And the ultimate holding period for non-affiliates was reduced from 3 years to 2 years. So again, kind of increasing or improving the liquidity as we continue to move on. And then lastly, 2008, that's when the holding period went from 1 year to 6 months. Or again, the ultimate holding period for non-affiliates went down to 1 year from 2 years in that case. So again, just over the years, continue to see sort of enhanced liquidity. And this will come into play when we look at the Stout study as well, and some of the dynamics and matters and attributes, I guess, that we keep in touch for each of them. So just a second bullet here too. I mean, there are ways for non-affiliate owners, it's important to note, to of unregistered stock to liquidate those shares prior to the end of the holding period. There are ways to obtain liquidity through certain avenues, one of which is, selling in a public transaction, citing some sort of exemption to the Securities Act that's allowed. You can sell to other creditor investors in privately negotiated transactions. You can persuade the issuer to register the shares at time of transaction through a registration right agreement, which we'll talk about and has a big play in terms of the data that we look at under the study as well. You can also hedge the position and kind of borrow against it and do some other ways. So there are ways, but again, otherwise the holding period is certainly there from purchase. So getting into it, I just mentioned sort of the registration rights, and this is important to talk about just in terms of when we're looking at the transactions that are in the study and what are kind of implied and what makes it somewhat difficult as well to analyze the data. But even with more relaxed limitations for resale that have occurred with those amendments that we talked about, investors often negotiate with issuers in these private placement transactions that allow for possible liquidity prior to the end of that required holding period. So these registration rights agreements typically come in one of 3 forms if they're included. There can be a demand registration right where basically requires the issuer to register the shares upon the purchaser's request, generally at the issuer's expense. So as you can imagine, these are really the most valuable, offering the most enhanced liquidity, but they are certainly the rarest as well that we see. The second being mandatory registration rights situations. So it requires the issuers to basically register the shares or a portion of the shares even within some time period. However, it certainly can be a long holding period, but there is still some benefit there, obviously, because there is a possibility of some liquidity prior to that holding period ending. And then lastly is sort of the piggyback registration right. So these typically grant the investors the right to register the shares when either the issuer or another investor initiates a registration of their shares. So it's typically viewed to be the least valuable, given the investor can't be the one that initiates the process. So the important things, again, just to keep in mind with sort of these restricted stock transactions is the presence of these registration rights agreements, which is becoming more prevalent, tend to improve the liquidity of those private placements of stock. There's no standard registration rights agreement, though, so it's important to note that it can be difficult to gauge really the precise impact that this has on limiting or enhancing marketability. Many investors may still be deemed affiliates, so they're still subject to the Rule 144. So really overall, though, just the key takeaway, I guess, is that viewing restricted stock is usually still less liquid than unrestricted shares due to the holder really being unlikely to force the issuer to register the shares. So sure, they do offer some liquidity, potential possible liquidity attributes if they have these registration rights agreement. But again, they're still viewed to be less liquid, certainly than unrestricted shares, just because of the time, effort, and potentially expense that's involved as well. So that's kind of just a brief overview on restricted stock. I thought it was important too, just to give, again, a quick history, not history lesson, I hate to use that term, but walking through the usage of restricted stock and sort of the evolution of how discounts for lack of marketability have been used and supported in preparing valuation. So initially, the source data for early valuation professionals was extremely limited, to where the approach most folks took was sort of this discounts allowed on prior court case type approach, where looking at recent court cases and looking at an implied discount that was applied in that case, basically just saying that that's appropriate to your instance as well. So sort of, not really considering the facts and circumstances. It's more just sort of a blind reliance on, other court case discounts that were applied. And over the years, this, as you can expect, certainly kind of been viewed as not the appropriate approach to use. But, at the onset, that's really what sort of the start was in terms of source data for discounts. Then kind of, in terms of moving ahead, there was a publication in I think, again, early 70s, 1971, I think it was the SEC study, kind of viewed as more of a benchmarking approach, which I'll talk about a little bit more as well. But essentially it was a tool based on, or a study based on, empirical evidence of private placements. I think they looked at a little over 300 private placement transactions that occurred of restricted securities. They kind of tied in a correlation just in general between various financial characteristics, sort of causing upward or downward adjustments to discounts, sort of really marked the beginning as well of other restricted stock studies being performed by other firms in the market or in the industry. Some of these other studies, though, were somewhat more limited in terms of the number of transactions that were looked at and sort of the indications or analysis that could be driven from them in terms of what the resulting was. But certainly each study has certainly merits in terms of the value that they can provide. And then over the years, the SEC study kind of came out of disuse just because of the fact that, some of these more recent studies relevant to the SEC study, I guess, did suggest higher discounts when you looked at sort of the average discount indicated by the study. But, a lot of, the process, as I mentioned, the sort of benchmarking approach, the process people would take was present a table similar to this, where it's showing the average discount of the various studies and just benchmarking your discount based on sort of the general range and picking the middle, or picking, again, kind of a similar discount. So that sort of, and I'll talk about that a little bit more, but that's sort of problematic as well, because it doesn't quite look at the financial characteristics of companies and market factors and dynamics that really do impact the upward or downward adjustments to discounts that would be appropriate in each case. And that's when we got sort of the Mandelbaum case, which I think was in the mid-90s, 95, 96, where both experts in that case utilized the benchmarking approach. So kind of presented all these studies, picked a discount based on that, and that was sort of the support for their analysis. And I think it was Judge Laro in that case who really identified there's kind of 9 different topics or considerations that need to be considered. They're kind of summarized in these 3 bullets here as well. But, the 9 are, and I wrote them down, but it's a financial statement analysis, dividend policy, the nature of the company, their position, outlook in the industry, management team, the amount of control of the transferred shares, restrictions on transferability, holding period, if the company has a redemption policy or a history of offering shareholder redemptions, consideration as well. Costs with sort of a public offering are the 9. So there's a lot of factors that were identified in that case. So it's certainly an improvement, because it's not just relying blindly on sort of a benchmark approach, but understanding that there are certain considerations that need to be dealt with in terms of estimating and approximating an appropriate discount. The difficult part was sort of the, it offers the qualitative benefit, right? But sort of the quantitative analysis of how much of an adjustment is made for these various factors, right? Other than just sort of a qualitative comparison. After sort of Mandelbaum, I guess the last bullet here is, again, the restricted stock comparative analysis. So there's one particular case Temple case that the court was presented with, I think, 3 different methodologies for a discount. It was a benchmarking approach, looking at these studies that had been prepared, sort of a quantitative model, where it's sort of looking at a discount cash flow type model to support a discount, and then sort of this restricted stock comparison. And the court actually favored the restricted stock comparison in that situation, just given that there was an attempt to kind of take those market factors and apply it to the subject interest, in deeming what seemed to be an appropriate discount to consider those various factors. So in order to do that, successfully, you do need to have sort of a sufficient database, right, of restricted stock transactions, and understand the characteristics that drive the discounts in those transactions, and just obviously having a general understanding of restricted stock as well. So these are sort of the roots in terms of what the Stout study is aiming to do. And obviously since then, I mean, in terms of gift and estate planning transactions, utilizing restricted stock does seem to be the most common approach for supporting discounts for lack of marketability, versus pre-IPO studies have somewhat gone out of favor. Option volatility models, things like that are certainly resources out there, but restricted stock is still a pretty prevalent use in terms of supporting those discounts. Just sort of walking through the Stout study, so it's sort of the next part that we thought was important here. So again, a little bit of just some backstory, which I think is just helpful to kind of set the framework here. But in 2001, FMV Opinions first began licensing the study through BVR to provide the valuation community with sort of this analytical tool to provide more detailed analysis in determining an appropriate for discount for lack of marketability, considering all of those factors that we talked about in previous slides that are important to consider. In March 2017, Stout acquired FMV, resulting in the study, really now benefiting from sort of the combined thought leadership and expertise of the combined firm. For those that don't know, I mean, Stout was first founded in 1991, really as a valuation firm, and one of the first service offerings we had is sort of providing these trust and estate valuation assignments. So having really essentially over 30 years now the experience in preparing these types of reports and exposure and things certainly has sort of benefited sort of the study as well, in addition to what FMV Opinions certainly had done as well. The study includes over 750, I think it's closer to 780 restricted stock transactions of private placements of unregistered common stock issued by public companies with sort of the distinct transaction and company characteristics on which comparisons can be made to your subject company and situation appropriately. It represents the most widely used and accepted database, kind of just adding what Adam mentioned at the beginning, that's available to valuation professionals for determining appropriate discounts for lack of marketability. We'll talk about another option a little bit later and just some of the differences there. But the last bullet on this page I thought was important to list, just in terms of our experience over many years, again, of putting these types of reports together and supporting them in audit situations. What we find have been most successful for valuation professionals in court in utilizing these studies. Those reports tend to do these 4 following things. One being performing a quantitative analysis with respect to each project, identifying the attributes that impact the magnitude of the discounts for each project. So, really kind of focusing on those Mandelbaum factors and other considerations, identifying the liquidity attributes of the subject interest. How do those factors tie to the specific interest that we're tasked with valuing or engaged to value? And then sort of performing that comparative analysis between the subject interest and the underlying subjects composed within the restricted stock transactions within the database. So all those things are things that you can do in utilizing the Stout study. So it's important to note that there's a lot of success in terms of utilizing the Stout study as sort of one tool in your toolbox. Just in terms of digging into sort of the DLOM calculator a little bit more, which obviously we'll talk about and walk through in a lot more detail. But just again, quick backstory. It was released first in fall of 2010. It's an interactive web-based tool that incorporates the inputs from a user's subject company, as I'm sure a lot of you are familiar with, and guides the valuation professional step by step through the methodology, how to utilize the study in determining what's an appropriate discount for lack of marketability. There's a lot of benefits what the Stout DLOM calculator offers. So I'll just kind of go through these somewhat quickly here. But first and foremost, it's really meant to greatly reduce the time and effort in deriving discounts for lack of marketability. So, in terms of utilizing the calculator, you're not necessarily starting from square one again, right? You've kind of got the framework in place. You enter the company's metrics, spits out data that's much more efficient to use. So the efficiency is a lot more improved with the DLOM calculator versus other aspects. It makes detailed comparisons between the subject companies and issuers of the restricted stock that are included in the transaction or in the study. Based on those metrics, then obviously deemed to have a statistical impact on sort of what enhances and what decreases liquidity. So those are all focused included within the study itself. Provides users with the options to exclude certain transactions with registration rights, what we kind of talked about, and adjust for specific holding periods that could, if the valuation professional deems it appropriate, to enhance sort of the detailed comparison. We'll talk about this a little bit later as well. It also provides users with an option to adjust the relevant financial statistics in the study for inflation to enhance comparability with the subject company, as of your particular valuation date. So we'll see this in practice a little bit later, but as you imagine, right, transactions going back to the early 80s, the level of total assets as of that date relative to current can't really be viewed on an apples to apples basis. So we do make some inflation adjustments to account for that to get everything on an even playing field. It allows the users flexibility to enter their own assumptions and tailor results based on their professional knowledge and experience. Obviously, there's only so much that we can do because it really does need to be considered on a facts and circumstance basis, depending on your particular situation, your company, and sort of the ultimate, purpose of the valuation. So we know every project is different. So it's really, like I said, and I'll say this probably a couple more times, it's meant to be one tool in the toolbox and guide a evaluator through the steps and what's important in truly defending their discount for lack of marketability successfully. And then lastly, it just provides users with the confidence that they're using the latest restricted stock data that's published by Stout. So those are really the benefits in terms of utilizing the DLOM calculator, and we'll obviously spend more time going through that. I did want to have a slide too, talking here, you'll see about sort of the selection criteria. So, in terms of receiving the transactions that may go into the study, we receive those from a number of different data sources. Most recently, it's been coming from Sagent through BVR. And really the first point here, it's important to note that when we receive those transactions, they go through an intense screening process, which I'll talk about, but they are added with a 2-quarter lag. And we'll talk about this a little bit more, but it essentially allows for appropriate amount of time for sufficient disclosures to come out around the transaction so that we can appropriately review and screen whether or not it's an appropriate transaction to include or exclude for various reasons. So, for example, right now, given the date, September 26th, we're just about wrapping up going through the screen of transactions through Q4 2023. And then obviously once September 30th kind of passes, we'll be able to start screening transactions through March 31st, 2024. So that's where that 6-month lag kind of comes into play. This second bullet may be one of the more important ones in the presentation, obviously, but once we get those transactions, we go through a very rigorous screening process of every transaction to determine whether or not we feel like it's appropriate to include, and I'll get into that a little bit more, but we go through and review all the relevant public filings, 10Ks, 8Ks, 10Qs, purchase agreements, registration rights agreements, just to understand sort of the facts and circumstances in play with each transaction. So this is where we're somewhat dissimilar from, for example, the Plurus database that's out there that I know a lot of folks use and can also license and subscribe to help support discounts. I think that database, last time I checked, had over 3,500 transactions, so significantly more transactions. But my understanding is the process to rule out particular transactions is not as rigorous as ours. So, I won't go as far as say there's strengths and weaknesses, because I'm obviously very biased in terms of what study I think is probably the best to use, obviously being the Stout restricted stock study. In terms of going through these transactions that we receive, I mean, literally probably over 95% of them, we remove them or eliminate them for various reasons, which is what we kind of list here. when we're considering fair market value, right, as sort of our standard of value, we have to consider willing buyer, willing seller, not specific investors or specific synergies or premiums that may be applied. So we really need to go through these transactions and understand, really only focus on sort of the plain vanilla type restricted stock transactions that may not have certain uniqueness that would cause the discount to be artificially higher or lower, and thus not a good comparison to use in our analysis. So it's important to note that that's really the big driver in terms of the difference. And I can certainly talk more about it, but just want to at least highlight it here. And then the third bullet, here's a list of really some of the main reasons why we're going through all these transactions and eliminate them for various reasons. So first, maybe the transaction was not a private placement of unregistered shares. We see that occasionally where they're already registered or shelf sale in that case. The private placement may include debt, preferred, convertible preferred, some other hybrid-like security that may not be identical to the publicly traded stock. Obviously, like I said at the beginning, right, we want to get two securities that are the exact same. The only difference being one is freely tradable and the other one has sort of this temporary illiquidity associated with it. If we start comparing various types of securities, that you're sort of comparing an apple and an orange in that case, and looking at the implied discount on those transactions isn't correctly impacting the features or isn't correctly being affected by the economics that we want it to in that case. Number three, the private placement was issued as part of a stock warrant unit or had warrants attached to it. It's possible the transaction did not close. It was announced but later withdrawn, and that's in part why we have this 6-month lag to kind of capture all those circumstances where maybe there was an announcement made, but if it did not close, we wouldn't want to include it in our database. Number five, the stock was not traded on domestic exchange. Could have been a 6K filing company, and that may have other rules or regulations that we'd want to strip out. Number six, the stock traded below $1 for the entire month of the transaction, or it had very low volume. So again, this kind of goes back to similar to number two, but any sort of penny stock type valuations, the volatility of the stock price, or if it doesn't trade in a kind of an appropriate daily volume, the implied discount that's calculated could be skewed based on other factors at play. So we typically try to screen those transactions out as well. Number seven, if we're unable to determine certain pieces of information, financial information, proceeds information, we typically strip those out if we can't verify them. Special contractual agreements between the buyer and seller. That's an important one. If the stock was issued in connection with a strategic business relationship or some sort of strategic alliance between the buyer and seller as part of an M&A transaction or something like that, there's other factors at play that we wouldn't want to include. And then lastly, really the lead purchaser was a related party. Maybe sometimes we see that they receive board seats as addition to the transaction that again would impact the price that's ultimately agreed to as part of the private placement transaction. So it's important to note too that the Stout study, dissimilar from some other studies out there, we do remove or exclude any implied premiums. So obviously opposite of discounts in the study. Likely in those situations, right, it's hard to believe that if you're dealing with two identical securities, one you can sell and one you can't, that the one you can't sell would be worth more in that circumstance. So sort of just the concept or the framework of lack of marketability somewhat breaks down that case. So with these transactions, we obviously do our best to understand all the details we can, but obviously there's only so much that's publicly disclosed. So our presumption is in those cases is there's usually some fact pattern behind the scenes that is impacting the relative price that's agreed on. So we typically exclude those in the study as well. Okay, and then just the calculation here, I thought this was important as well because we often get this question in terms of how we determine or calculate the discount for each transaction. The formula itself in theory or on paper, when you're looking at it, is pretty simplistic. It's just looking at the difference between the private placement price that's agreed upon by the issuer and buyer in that case, and the investor in that case, over the market trading price of that security. So just to jump ahead to the very last bullet here that's bolded, as an example, if we were to see that a private placement price is negotiated at $90 per share, and the market trading price that we're using is $100 per share, the implied discount based on that formula then would suggest a 10% discount, if that makes sense. So that's kind of how the math works. But it's important to note and go through each of these other bullets as well, that basically helps us understand or determine, well, what do we use for our variable B in this case, which is the market trading price per share. If in our documents and disclosures, it's stated explicitly what the discount is, we'll rely on that transaction discount that's agreed to between the, issuer and purchaser. If it's not stated, which frankly is more common, the transaction discount is the percentage difference between the private placement price that's negotiated and the closing market price as of the date prior to the agreement date. So there's usually, agreement date, announce date, closing date of the transaction. So typically we take the day before the agreement date. If the agreement date is not known, the market trading price represents the closing price as of the date prior to the first to occur of either the announced date when it's announced publicly or the closing date of the transaction. And there are some transactions where only the month of the transaction is disclosed or specified. So in those cases, we usually look at the high-low average of the stock price over the month of transaction, use that as sort of a variable. So again, sometimes we get the question in terms of how is the discount actually calculated. So we just thought it was relevant to kind of walk through this. And then next, getting into a little bit more in terms of analyzing the data that's in the study. So again, as I mentioned at the beginning, it includes the result of this screening process basically has provided almost 780 plain vanilla private placements of restricted common stock that basically screen out all those circumstances that we think would distort the discount in ways that we don't think are appropriate to include within our selection of a discount for lack of marketability. Currently, it includes transactions, again, from July 1980 through September 2023. And as I mentioned, we're currently screening at the moment for Q4 2023, just considering the lag. And what's important is the second bullet here, that the data can assist valuation professionals with identifying certain common company-specific broader market risk variables that are determining for discount for lack of marketability. That's one thing that they can do. In terms of issuing or including the issuer's overall risk profile. So that's really one piece of information that's important. It helps us, secondly, understand the degree of liquidity of the privately placed stock is important as well. And then third, the overall level of the stock market volatility around the time of the transaction. So these three important factors that we learned from the database and learned from the study are what essentially go into the DLOM calculator in terms of how we estimate or build up to an appropriate discount. So, I do have a subsequent slide for each of those three that we'll kind of expand on a little bit more in more detail. And then, the table here, again, is just kind of showing the transactions in terms of the dispersion across the discounts for each of those almost 780 transactions, and then the average and medians across all of those as well. So as I mentioned, three important factors, right? The first being sort of investment risk. So the impact of investment risk, really has a pretty strong impact on the discount for lack of marketability, and it's significant as well. And these go to a lot of the factors that were included in sort of the Mandelbaum, decision as well, and other just, quantitative qualitative factors that cause upward, downward adjustments to discounts. So for example, smaller, less profitable companies with higher degree of income and balance sheet risk, higher stock price volatility tend to typically issue restricted stock at higher discounts. So this table here, again, a lot of numbers here, I'll try to just summarize it, but what we essentially do is we look at, sort all of the transactions based on their discount, the implied transaction discount, and split that data up into 5 quintiles, and then calculate the median statistics, financial characteristics for each of the companies in issuers in each of those transactions, and then you can kind of see the results here. So as I kind of mentioned with the second bullet here, looking at market value of equity, for example, as the companies get smaller, the implied discounts based on those transactions, not considering all other fact patterns, right, but just based on that one variable, suggest higher discounts for smaller transactions. And that's essentially what these other characteristics are basically showing as well, just in terms of relationship correlation relative to the discounts being lower or higher. And then just important to note too, just in the very bottom, as I mentioned, adjusting for inflation. So again, some of these transactions go all the way back to 1980. So we do make the adjustment to bring everything forward or current to a more recent date. So it's more of an apples to apples playing field when we look at comparing total assets of a transaction that occurred back in 1985 relative to the dollar total assets that occurred last year, for example. So that's investment risk. The second factor that really we learn a lot from the study and the data, underlying data, is sort of this degree of liquidity component. So the study also provides data on variables that are directly associated with the liquidity of a block of restricted stock sold in each private placement, which is obviously very important when we're looking at privately held companies that are really viewed to be highly illiquid. The restricted stock transactions already have sort of an established trading market, right? Because they have another class of stock that's freely tradable. So they will eventually be publicly traded, which is very dissimilar, obviously, from private companies where they don't have that eventual liquidity to look forward to in their future. The second bullet here, I mean, it can be very difficult, obviously, to estimate holding period for each transaction. And this kind of goes into some of the reasons I brought up some of the history of restricted stock. You have an understanding of affiliate versus non-affiliate owners that could cause some dispersion in terms of the estimated holding period, current and non-current issuers, other registration rights, things like that. So it can certainly be a difficult exercise. So, but what we have learned is all else equal, larger blocks of unregistered stock, as expressed as a percentage of total shares outstanding is how we calculate that, are more illiquid than the smaller blocks, resulting from Rule 144's value limitations after the initial hold, as well as just the difficulty of disposing of a block of stock given market supply and demand considerations. So this table here, what we're showing is when we look at the block size for each of the transactions and how they fit into 0 to 10% of the block was issued as part of the private placement all the way up to greater than 40%, there's a pretty clear divide that for those block sizes that are less than 30%, the median discount of those is 15.3% versus the discounts that offer, or the transactions have a block size greater than 30%, the median discount of those transactions is 38.8%. So a key observation here, obviously, is that larger blocks are typically much more illiquid, and so they more closely resemble private equity. And that's a big factor that we consider when we're utilizing the Stout DLOM calculator, and that's a specific adjustment that we make. So understanding that relationship is important as well. And then the third factor is market volatility that we've kind of learned from looking at the data underlying the database. So it provides data regarding the impact of sort of broader market risks that may be measured in terms of volatility in equity markets as of the date of the transaction. So what we do here is, an analysis of the discounts associated with the transactions occurring during periods of very high market volatility, given sort of a fixed level of company-specific financial characteristics, as well as the degree of liquidity, so the 30%, less than a 30 or greater than 30%, kind of taking those things aside, the data suggests that discounts are typically higher during higher volatility periods during normal periods. So each transaction within the study is essentially then assigned a market volatility variable around the time of the transactions. And we use VIX values in this case, which is, again, meant to be sort of representative of the level of the expected future volatility as of that date. We calculate sort of current VIX levels, 1 month average, 6-month average for each transaction. And what we've learned is what's kind of presented in this table here, where we basically took a subset of the data that occurred during a time period where there were no changes to a 144, in terms of the amendments that were made. And also during a time where there were some higher levels of volatility versus lower levels, so we can get a good sample size. So we looked at transactions, 333 specifically, that occurred between 97 and 2007, sorted those based on their VIX as of that representative date of each transaction, and looked at the discount that occurred for those transactions that had a VIX of between 11 and 23.1 in this case, and the median discount being 12%. And then the higher VIX, the transactions that occurred during higher VIX levels was a lot higher, 25.7%. So that was something that we considered as well. So the data really just underlying shows that there is certainly a dispersion in things that we think about, and that volatility does have an impact on it. And then just two last tables. I just think it's important to highlight. I won't go through these in too much detail, but just touching on things that we've talked about, where again with the Rule 144 amendments, looking at those transactions that occurred during certain time periods where the initial holding period was potentially less than the 2 years, those transactions have decreased over time. And then also looking at registration rights as well. Those transactions that had registration right agreements in place versus those that didn't often had lower discounts for those with registration agreements. And again, these are things we'll think about or talk about when we look at the DLOM calculator itself, which is what we're going to kind of get into now. So obviously, as valuation professionals, we're often tasked with, understanding the levels of value framework, right? Are we valuing things on a control basis, non-controlling? So the DLOM calculator really consists of either a 2 or 3-step process, which we'll talk about, focused on adjusting for those 3 things that we talked about: issuing firms' financial and market risk, so investment risk, the level of volatility that we just talked through, and then also the degree of liquidity of the securities relative to those of the transactions. So this table here is kind of just meant to show sort of that step going from a marketable, non-controlling interest level of value, which you could argue is sort of a public equivalent because it's a marketable security, but you can't control the public company just by owning a single share, and how you take that step down to an investment in minority interest of a private company, non-marketable, non-controlling in that case. So it's a 3-step process. The first is sort of this restricted stock equivalent discount, which accounts for the firm's financial and market risk, looks at the financial characteristic comparison, which we'll talk about, and excludes those transactions that have a block size greater than 30%, because those discounts are kind of influenced by other factors outside the financial characteristics and are used in sort of the last adjustment here that we'll talk about. The second adjustment, if it's appropriate, is looking more at broader market risk, as we talked about. So looking at sort of the equity markets and understanding the appropriate VIX and what's appropriate as of the valuation date, and seeing if that's an adjustment that is necessary to make as well, given the facts and circumstances of your specific project. And then lastly, we have to make an adjustment for the fact that we don't have the luxury of eventually receiving liquidity in an already established market, right? Like these restricted stock transactions do. So we look to those transactions that did have a block size greater than 30%, that has sort of a much longer holding period, much more similar to private company valuations that we're typically utilizing this data for, and utilize that to adjust our restricted stock equivalent discount more towards a private entity or private company discount to account for that longer holding period. So again, just in summary here, two key considerations just in terms of utilizing the data here. First being that, non-controlling interests in private companies should typically be considered less marketable than restricted stock in public companies, again, because interests in private companies have no market, whereas the public companies do have an already established market and will become eventually fully tradable. So it's important recognition. That's why we have the multiple steps here that we do. Lastly, we do sometimes get the question of, well, why does Stout not advocate just for a direct comparison to those larger than 30% block transactions? Skip steps 1 and 2 and just look at the comparison to those. The main reason being is that there's really a smaller sample size of those transactions. So statistically, it may not be the most significant to look at both financial characteristics, consider market volatility, VIX adjustments, and the longer holding period based on that smaller sample size. So we think it's still appropriate to take more of this multi-step prep to leverage all of the details and all the transactions that are in the study. So we'll switch over here. Hopefully this works okay, but I did pull up essentially the way it looks through BVR, and I thought it would just be helpful to walk through sort of a quick example in terms of how to utilize it and how we approach each step. So we'll start putting in just some kind of dummy numbers here. We'll use a current valuation date and just kind of walking through these. So we kind of touched on some of these already, but in terms of adjusting inflation, right? In most cases, yes, we want to pull all of the transactions going back to 1980 that we want to subsegment from. We want to pull all those to a current date. So again, it's all on an apples to apples playing field. So that's typically always yes. Trim dates, if we were looking at an evaluation date back in 2020, for example, we would not want to include any transactions that occurred after our valuation date. So we'd only look to transactions up until that date. So we would typically always have yes there. We typically include all registration rights and all holding periods. We'll talk about that a little bit later. And then, you enter in the company's financial information for, a couple key variables here. So I'll just put in some dummy numbers here, and it's all entered in thousands. So it's important to note. Let's say revenues are 150 million. Let's just say it's the same as equity. We'll say book value of equity is a little bit smaller. And then maybe we apply like a 5%. And volatility, I did leave that blank. Typically for operating companies, we deem it hard to obviously make an estimate for a private company's volatility. I mean, you can maybe look to public companies within the space, but even then, estimating a volatility for a private company is obviously very difficult to do. So typically that's an assumption we leave blank, but again, it's up to the ultimate valuation professionals, judgment and, what they deem to be most appropriate and defendable in their case, given their facts and circumstances. So clicking next just kind of summarizes the data that I've input here. Clicking next again goes to the first step of 3 that we'll consider. And in this first step, we have 2 different approaches that help us estimate, again, this restricted stock equivalent discount based on looking at a financial characteristic comparison. So I know there's a lot of numbers on this page. I'll switch back quickly to the slides here because I did want to show this table that kind of shows it a little more, a little easier, I guess, to understand. So essentially what we do is for each of those variables that we're including, we sort the data, again, based on the size, in this case, total assets, look at the median discount for each of those quintiles then based on the low all the way to the high. So in this case, you can see that as you get smaller, the median discount indicated by, your company's size gets larger. So in this case, we put $75 million in for total assets, which fits within the third quintile here and suggests a median discount of 15.5%. So it's essentially what we're doing for each variable that we're looking at. We look at our subject company value, which quintile does it fit in, what's the range suggested by that quintile, and then what's the median discount suggested based on that. And then you'll apply, suggested weights, which again, this is a facts and circumstances case. I'll just use the weights that we typically suggest based on those suggested weights, and you'll see it suggests a restricted stock equivalent discount using this first approach, and we'll see a summary of this in 2 slides here. The second way that we can estimate a restricted stock equivalent discount is basically a different slice of the data where we're looking at each of the variables, again, that we want to include. We're not including volatility because we didn't include that initially. And then this is important here. This middle section here is what we want to focus on. So essentially what we're doing here is we're calculating the number of matches where whatever quintile our subject company variables are in, how many times do we match with each transaction at least one variable where we're in the same quintile. So you can see on one end of the spectrum, there's 533 transactions. Of all of them that are in the study where we are in the same quintile for at least one of our variable of these 6 variables that were included. And we present all the way down where you can see there's actually one transaction in the study where we're in the same quintile for pretty much all the variables in that case, and that suggests a discount of 14.4%. So, you could argue, okay, that's like the perfect match, right? We're matching, we're in the same quintile for all transactions based on the financial characteristics, but you start to deal with sort of sample size. You're only looking at one. Is that an appropriate sample size to use? So we do kind of present the build-up showing all of the matches based on the number of matches that you have. And then clicking next will kind of summarize the data between those 2 different schedules. And then you'll make a selection for an RSED based off of that. So looking at sort of the weighted average, the average and medians, maybe just for round numbers, again, just to get the model working, maybe we think 15% is appropriate in this case. Next is sort of we've selected the RSED, the restricted stock equivalent discount. Then we're going to look at the VIX adjustment that's appropriate. In this case, you can see that as of the valuation date and leading up to the valuation date, the VIX level is less than the 23.1 break point between low and high VIX periods. So in this case, we're going to apply a 1, assuming that there's no adjustment that needs to be made. And then the third step is, again, adjusting our RSED in this situation to a private entity type level discount to account for the longer holding period. So in this case, again, this is looking at the smaller block or larger block transactions and in calculating an implied discount, or I'm sorry, a multiple based on what we think is appropriate. And we can go through in more detail how these are calculated. It's somewhat very mathematical, but again, I'm happy to talk through that. But basically, we argue that for private companies, the implied adjustment that needs to be made to the R set is between a 1.6 and 2 times adjustment for the 40th and 60th percentile. So that suggests a discount for lack of marketability between 24 and 30%. So if we just think that's a good indication, and we think being in the midpoint between there, it's just sort of the average between those, maybe that's what we think is an appropriate discount. Type in 27, click next. Just kind of a summary, and again, we think the 27 may be a good indicator. Then next you sort of get an output that, again, this can be included in your report, but basically summarizes all the steps and the assumptions that we made and makes it sort of easy to download and include in your report. But that's sort of the mechanics, I guess I'll say, in terms of how the discount or the DLOM calculator is used. And I understand people may have specific questions relating to specific situations they've had, which again, I'm happy to, we're happy to walk through, but again, it's really a facts and circumstances case, and it's really meant to be just, again, one of the tools in the toolbox, and there may be reasons why you want to pick an RSED towards the lower end, or I'm sorry, a PED adjustment towards the lower end of that 1.6 to 2 times range. So all things that need to be considered in terms of for each situation that you're working on. I know we're somewhat running out of time, but this really just is the last slide here, just talking through, again, some of these unique situations or questions that we often get. So one of which is the shorter holding period. Sometimes in situations, if we're doing evaluation for a company that may have somewhat of a imminent liquidation coming up, 6 months, 1 year into the future, or if we're doing evaluation of restricted stock for a blockage discount type valuation, and we need to sort of estimate the discount appropriate with estimating a holding period where we think, okay, a large block of stock in a public company may take 6 months to liquidate. We may want to focus in or just trim down and look at those transactions that occurred during the 6-month window, and then obviously not apply a PED adjustment because we don't have that long certain holding period like a private company does. Controlling interest valuations, we do get this question a good amount as well. For 100% valuations or controlling interest valuations, it's sort of Stout's policy. We do not apply discounts in those circumstances, just given the ability of a 100% owner to eventually get liquidity or kind of receive liquidity in some capacity. So that's sort of our approach in those situations. And when you look at the underlying data, right, we're dealing with 2 classes of stock, one being freely tradable, it's marketable, it's non-controlling, and then the restricted stock that will eventually be marketable, so it's sort of limited marketability, but it's still non-controlling. So the underlying data is all based on non-controlling data. So in terms of that input, again, we typically, for most cases, do not apply or really kind of view a discount to be applied in that case, understanding though there's a lot of facts and circumstances, so there's not a one size fits all. And then we do get the question too in terms of the applicability of it relating to asset holding companies, so holding companies owning marketable securities and other similar assets. So obviously the underlying data and all the transactions are based on operating companies, right? So there's sort of that lack of inherent direct comparability. But what we do is we often still rely on the data. We think it's still applicable. We just make certain adjustments to the weight of those different variables that we use. 2 in particular are the MTB ratio, market to book ratio. For a portfolio of marketable securities, there's really no intangible value there to where you'd expect market and book values to be pretty close to 1, which would suggest lower discounts. So we usually put more weight on that factor, as well as volatility as well. If you have a large portfolio of marketable securities that are well diversified, you probably could expect in that case the volatility of that portfolio to be pretty low. So usually we suggest, the first quintile that suggests a lower discount for that. So, again, a consideration of how you would look at those different variables relative to a holding company, relative to an operating company could be considered. And there definitely is instances where we certainly rely on utilizing the study and the database for all of our holding company valuations that we look at. So those are at least the 3 kind of main questions, I guess, that we typically get. And certainly I know there's more, but with that, I guess that sort of sums up at least what I thought I wanted to talk through. So, I'll turn it over to Adam in case you had any closing remarks, Adam, that you wanted to make? And I know a couple questions came through that we can certainly try to address, or maybe we can address later as well and reach out to those folks directly.
No, thank you, Patrick. Did you want to address any of those questions now, or would you like to follow up offline later?
Yeah, I haven't had a chance to look at them yet, so it may be best to follow up offline if that works okay for you.
Okay, excellent. Yes, we'll definitely make sure we follow up on any outstanding questions. On behalf of BVR, I want to thank Patrick for an excellent presentation. As a reminder, to receive CE credit, you must complete and submit a brief survey on this webinar. A link to the survey is provided in your login email and on the reading page for today's webinar. Your feedback is key to providing the best possible programs for you, so please provide us with any suggestions you may have. If you choose to fill out the survey now, your browser will automatically direct you to the CE credit page when I finish speaking, so don't disconnect. The survey will be active for 5 days and must be completed before we can process certificates. After 5 days, we will process your CE and send your certificates via email. If you have any questions related to the content or format of this webinar, please email our training manager at training@bvresources.com. And coming up for more BVR webinars we have, on October 7th, our quarterly power panel is back on stage to discuss trends and issues in business valuation. Our panel features Ken Pia, Michelle Gallagher, Neil Beaton, and Jeffrey Tarbell. On October 8th, we have another webinar in our compelling case study series webinar titled Unraveling Financial Deception, Divorce Case Study for Experts with Michelle Laws. You can find additional offerings on our calendar page as well under live events. Thank you all for listening and have a great rest of your day. We are going to end this webinar now, so please go ahead and